India's daily fuel pricing, a system of managed volatility stable retail prices, mask a complex daily revision mechanism tied to global markets.
The headline petrol and diesel prices for February 7, 2026 present a snapshot of significant regional disparities within a framework of national price control.
While the daily revision by oil marketing companies OMC suggests the dynamic market, the underlying reality is one of managed stability where taxation and informal controls dampen the full transmission of international crude oil price volatility to the Indian consumer.
The core conflict lies between a market-linked pricing ideology and the political economic necessity of shielding consumers from extreme price shocks, creating a system where daily changes are often minimal despite a formula designed for daily reflection of global costs.
The architecture of fuel pricing in India, a tripartite model of international benchmarks, currency risk, and layered domestic taxation.
India's fuel pricing mechanism is not a simple pass-through of global rates.
It is built on a daily dynamic pricing model formally adopted by OMCs, which theoretically adjusts retail prices every morning at 6 a.m. based on a 15-day rolling average of international crude oil
Platts Dubai and product prices, converted at the previous day's rupee-dollar exchange rate.
This technical process ensures price notification is linked to global movements.
However, this market-facing mechanism is heavily mediated by domestic fiscal policy, where central excise duty and state-level value-added tax VAT constitute over 40–50% of the retail price.
The so what?
Is profound. This structure means price stability or changes are as much a function of government revenue strategy and interstate tax competition as they are of global supply and demand, making fuel a key fiscal tool and a politically sensitive commodity.
Decoding the February 2026 price matrix, regional price differentials reveal the dominant role of state taxation over base fuel costs.
The data for February 7, 2026 provides a clear analytical lens.
The extreme variance in petrol prices from rupee 94.30 in Chandigarh to rupee 107.50 in Hyderabad cannot be explained by logistics alone.
This rupee 13.20 per litre gap is primarily driven by differing state VAT rates and local levies.
For instance, Mumbai and Bengaluru show high prices due to substantial state taxes, while capitals like New Delhi and Lucknow benefit from relatively lower tax regimes.
Notably, diesel prices show less volatility, reflecting its status as a transport and inflation-critical fuel often subject to softer taxation.
The four price controls referenced in the content are critical. OMCs frequently absorb minor global fluctuations to avoid public backlash, leading to the observed largely remain stable outcome.
This creates a subsidy-like buffer funded by OMC margins, blurring the lines between a deregulated and administered pricing system.
The strategic verdict on fuel pricing: a system optimized for political and fiscal stability, not market efficiency.
The future outlook for India's fuel pricing is one of continuity within constraints.
The daily revision mechanism will persist as a technical framework, but its true purpose is to provide a smoothing algorithm rather than real-time price discovery.
The strategic verdict is that this hybrid model is likely permanent, as full deregulation poses unacceptable political and inflationary risks.
Predicted consequences include sustained fiscal reliance on fuel taxes by both central and state governments, and continued periodic interventions either through tax cuts before elections or directives to OMCs to freeze prices during global spikes.
For consumers, this means the convenience of SMS-based price checks will reveal minor fluctuations at best, while major shifts will remain discretionary policy decisions, not purely market outcomes.
The system's resilience will be tested during prolonged periods of high crude oil prices, forcing a choice between higher retail costs, reduced government revenue, or weakened public sector OMC balance sheets.